Welcome to the lecture Bookkeeping to Trial Balance, ICB. My name is Ms. Akwenge. I have a Master's in Accounting and Finance degree, Bachelor's of Accounting. Please find my contact details, which is 081 46 99 338 for any questions related to the following slides, or also the topic or subject. Let's look at activity number 1. You will find it on page 22. You are required to calculate your non-current assets, your current assets, your current liabilities and non-current liabilities, your owner's equity, and then you have other questions defining what assets, owner's equity, liabilities, income, and expenses are. Calculating current assets. You have your amount of the equipment, which is 120,000, your vehicles, which is 180, your land and buildings. So in total, your non-current assets are 700,000. Moving on to our current assets, your debtors control account is 24,000, your petty cash is 4,000, and your cash float 1,000, and your trade inventory 15,000. Your total current assets are 44,000. Note, the bank balance is not included with current assets since it is an overdraft. It will thus be included with current liabilities. Remember, if your bank is in an overdraft, it means that you are owing the bank and you need to pay the bank back. So you can't say that it is an asset. We will go into detail with this one also when we define the definition of an asset and the definition of a liability. Your non-current liabilities are made of your mortgage loan, which is 250,000, your loan from Pleon's Bank. Now there's a trick here. He already had an account of 124,000 alone, less the 24,000, which was made up of your redeemed loan. So in total, your loan from Pearl's Bank will only be 100,000. Your non-current liabilities will therefore be 350. If you refer to the book, it clearly states your loan from Pearl's Bank is 124,000. But your loan, there is an amount of 224,000 which is redeemable by the 28th of February 28. Moving on, your current liabilities are then made up of your bank overdraft balance, which is unfavorable. Remember that we have explained that it was not going to be included in your current assets because it's a current liability. Your unfavorable means it's in negative, and favorable means that it's a positive. And your bank overdraft is made up of 2,000. Your creditors control is 30,000. Your short-term portion of long-term loan is 24,000. Your total current liabilities are 56,000. Your owner's equity, if we need to calculate our owner's equity, we are going to say total assets, which were calculated in the previous slides, are 700,000 plus 44,000, which are made up of your current assets plus your non-current assets. Your total liabilities is 350 plus 56,000, which are made up of your current liabilities and your non-current liabilities. If you say your total assets less your total liabilities, you will get 338,000, which represents our owner's equity amount. Now we will define what an asset is, what your owner's equity is, what your income is, what your expenses is, and what liabilities are. Let's look at assets. Are resources controlled by the firm as a result of past event and from which future economic benefits are likely to flow to the entity. Example, a land and buildings. Your debtors, those are all examples of assets. Your owner's equity refers to the net results after deducting the liabilities from the assets. It refers to the wealth of the owners in the business. Let's look at your owner's equity. They said is the total amount that you have, your total assets, minus your total liabilities after deducting all your liabilities. Then you'll have owner's equity. It's clear that from our calculation of owner's equity below that the definition is explaining the same thing. It refers to net results after deducting the liabilities from our total assets. Liabilities are present obligations as a result of past events which need to be redeemed in future. Example, your creditors control account, your loans, those are all part of liabilities. Your income is brought about by an increase in assets and or a decrease in liabilities and causes an increase in owner's equity. Expenses are brought about by a decrease in assets and or increase in liabilities and causes a decrease in owner's equity. Very important that you ensure that you know the 5 definitions of your assets, your owner's equity, your liabilities, your income, and expenses. It will also help you in the exams if you know these definitions and if you can go through them with examples. Let's move on to activity number 2 on page 29. You were required to show the effects of assets, owner's equity, and liabilities on various transactions. Let's look at transaction number 1 in your book. It says, Roger Prince commenced business as a sole trader on 1st August 27. At this point, he only had 40,000 in the bank, being 10,000 from his personal funds and 30 from the bank in the form of a loan. Roger entered into the following transactions during August 27. Already there in the first paragraph, we have a transaction that we need to record. We say that 40,000 is what Roger had, but remember 10,000 is his personal loan, so your owner's equity will be affected with 10,000 because it was a personal loan that he made. Your 30,000, he said he borrowed it from the bank, so based on the definition of liabilities, your 30,000 will then be a liability, amount that we need to pay. So in total, your assets are 40,000. Let's look at number 2. Cashed a check for 2,000 being from petty cash. There's no effect on either your owner's equity or liabilities in this transaction. Why is there no effect on both of these accounts and only on your cash assets? Because the bank, the money that was taken, the 2,000, was initially taken from your bank. So your bank was minus with a 2,000 and you have petty cash of a 2,000. So your bank decreases with 2,000 and your petty cash increases with 2,000. Both of these accounts relate to assets. Let's look at number 7. Purchase merchandise trading inventory by check 11,000. Again, the same thing. Your owner's equity was not affected and your liabilities was not affected. Why so? We took money from our bank, which means our bank minus. That's why you'll see minus 11,000. And we bought inventory, stock, which means our stock increased with 11,000. All of these are asset accounts. Let's look at number 21. Purchase office equipment on credit, $12,000. Number 21, your owner's equity is not affected, but our liabilities and our assets are affected. Meaning that our liabilities we took on credit, we need to pay back this person. So our liabilities increase with $12,000. And our assets, we bought land. We bought office equipment as per transaction number 21. So which means our assets increase also. Let's look at number 31. Day 31. Redeem paid off 3,000 on the bank loan. Meaning our liabilities decreased with 3,000 because we paid off our loan. And our assets also decreased because we used money to pay for the loan. So in total, all our assets is 49,000, our owner's equity is 10,000, and our liabilities is 39,000. There has been no change in owner's equity during August 2007. Why are you saying there has been no change? Because the only activity or the only transaction was in the beginning of the year where he took a loan, where he also took personal funds of 10,000. Throughout the month of August, there was no change in owner's equity. Findings. When only assets and or liabilities are involved in a transaction, there will be no effect on owner's equity. This can clearly be demonstrated if you look at day 2, day 7. Those are the only transactions where even day 21 and 31. If only assets and liabilities are involved in a transaction, your owner's equity is not affected. In this example, none of the transaction had an effect on owner's equity. If a business buys an asset, takes out a loan, or pays off a loan, it does not alter the owner's wealth. Activity number 3. Let's look at page 76. In this exercise, you were requested to calculate your VAT amount, your VAT inclusive amount, and then your VAT exclusive amount. Let's look at number 1. You were supposed to calculate your VAT amount and your VAT inclusive amount. Your VAT exclusive amount was 439.45. The VAT is 14%. So if you say 14% times 439.45, you will get 61.52%. Your total VAT inclusive is 439.45 plus 61.52, which will give you an amount inclusive of 596. Your next exercise, you were given the exclusive price of 7,897.50. Your VAT amount, if you say 7,897.50 times your 14% VAT rate, you will get 1,105.65. If you say 1,105.65, which is your VAT amount, after you times your exclusive amount with 14%, you will get 9,003.15 cents. Just to show you how this works. We said our VAT exclusive amount is, for number 1, 439.45. We know that our rate for VAT is 14%. 14% times our VAT exclusive amount is 61.52. If you add your VAT exclusive amount plus your 14% for the VAT, you will get 597. That's your VAT inclusive amount. If you want to calculate your VAT inclusive amount, for example, in number 3, where your VAT inclusive amount was 137.37, you will say that amount 137.37 times 1 divided by 1.14. Then you will get your inclusive amount of 120.50. If you want to get what the VAT is, you will say your VAT inclusive amount, because this amount includes your 14% VAT. You will say 137.37 less less your VAT exclusive amount. So this is VAT inclusive, this is VAT exclusive, and then you will get your VAT at 14%, which is your VAT inclusive amount, because this amount already has your 14% VAT, and your VAT exclusive amount 120.50 doesn't have VAT in, and then you will get $16.87. So this is how you calculate all those amounts. If you want to get the VAT exclusive amount and you have the inclusive amount, this is what you do. You have the inclusive amount of 137 less your 14%. Always remember the difference between VAT inclusive and VAT exclusive and VAT. You need to know the difference between the three for the exams as well. Your VAT inclusive amount means your 14% VAT is included in this amount. Your VAT exclusive amount means your 14% is not included in this amount. Your VAT means 14% VAT on exclusive amount. Very important that you know the three differences between each other and how they are calculated as well. Just the tip, if you have the VAT inclusive amount, example $10, to get the exclusive amount, we will say 10 times 1 divided by 1.14. If you have your exclusive amount, for example, it being $10, you will say that times 14% will give you the VAT amount. So, very important that you take notes of these two calculations. If you just want to calculate your VAT amount straight on, if you just want to calculate the VAT at 14%, you use your VAT exclusive amount. You use your VAT exclusive amount and not your VAT inclusive amount, because remember, your VAT inclusive amount already has the 14%. Good luck with your exams, and this is the end of this slide.